let's look at how a re-advanceable mortgage is set up. A re-advanceable mortgage is based on the market value of your property, which must be appraised at the time of mortgage application. I'm going to start entering some numbers in the spreadsheet, and over here you're going to see a graph start to appear. So let's, for simple math, let's set a home at $1 million because then it's easy for us to do the mental math. With a re-advanceable mortgage, the global lending limit, which is the most that you can borrow on your property, is set at 80% of the appraised value of the home. This is called the global lending limit, and here you can see it's $800,000. Within the global lending limit, you can have multiple components, multiple debt components, and you can slice that pie in a number of ways. Let's look at a borrower who has a $500,000 mortgage requirement. So of the $800,000 global limit, $500,000 becomes a regular amortizing mortgage. And in this example, the mortgage payment is $2,250 per month. You can see of their $800,000, they have a $500,000 mortgage, and the balance of the global lending limit becomes a line of credit limit. In this case, $300,000. If the only debt you have on your house at the moment is $500,000, then you will have access to $300,000 by simply writing a check. Now, here's the magic of a re-advanceable mortgage. Let's show you the impact of paying down your mortgage. And this is how a re-advanceable mortgage differs from a regular mortgage and a line of credit, which are standalone products. So let's reduce your mortgage through regular payments. So I'm just going to modify this formula for a moment. Let's say you make one payment of $1,000 toward your principal balance. We now have your mortgage is reduced by $1,000. As you can see over here, the line of credit grew by 1 to 301, and the mortgage itself dropped by that same $1,000. Over the course of a year, for example, $12,000 in this example, your mortgage was reduced. Your mortgage balance remaining is $488, and your line of credit is $312. Together, both segments add up to $800,000. So let's look at mortgage payments over time. So let's just simply go from 1 year to 2 years. You can see the mortgage balance is reducing, the line of credit is increasing. Let's go to 3 years. As you can expect, the mortgage is down by $36,000 and your line of credit is up by $36,000. So let's look at why this re-advanceable mortgage is such a great product. Let's look at a couple of scenarios where you have the opportunity to make some sort of investment. Let's say you need $120,000 for a business expense or something. You simply walk over to the bank and you withdraw $120,000 on your line of credit. Let's watch what happens when we do that. Your mortgage remains the same. You now have a $120,000 line of credit balance owing, and your remaining line of credit available is $216,000. The three components being your mortgage, your line of credit, and your limit or remaining balance still total $800,000. In this scenario, you'll have a minimum payment of interest only. So perhaps that might be $300 per month on this $120,000 balance. Now let's say in a few months, the $120,000 you lent to your business comes back. You simply repay that to your line of credit, and your limit goes back to $336. And let's say you've paid down a few more mortgage payments in the meantime, and you now have a remaining balance of $458. Now let's look at a different scenario. let's say you wish to purchase a rental property and you're trying to come up with your down payment. Let's say you need $100,000 for your down payment for a rental property. So you can simply advance this on your line of credit. In fact, you can show that you have that available space to your mortgage lender, and it will prove that you have your down payment. Now, this is a line of credit is typically an open loan, which means it can be paid back at any time without a penalty. And for that, you typically pay a little bit more interest expense. But let's say that $100,000 that you've just put on your line of credit for your down payment, you plan on having that debt for a long time. So what you can do is actually convert that debt into an amortizing mortgage. So some readvanceable mortgage lenders allow you to have more than one mortgage segment. So in this case here, let's say we can lock in $100,000 that's on our line of credit. We can lock it in to a fixed rate amortizing mortgage to protect ourselves against rising interest rates, and also to get a lower rate that you'll get with a regular mortgage product. So we convert the HELOC or the line of credit into an amortizing mortgage, and that money reduces the HELOC balance back down to zero. You no longer have an interest payment. Now you have your regular house payment, and you have a $100,000 investment that you made in the rental property. Under Canadian tax law, because you borrowed this $100,000 to make an investment, the interest is tax deductible as long as we can isolate that interest expense, which you can with the reporting on a number of these readvanceable mortgage products. Let's look at one last scenario. Let's say a little bit more time has passed paying down your mortgage. You've got a little bit more capacity on your line of credit. Let's say you like cars, and there's an opportunity to buy a collector's car that's sitting in a farmer's barn, and you can get that car for $50,000. And you say, wow, that's a heck of a deal. So you buy that car immediately on your line of credit. You don't need any kind of approval. You have access to that cash immediately. Let's say that you're going to take that back to your house and you're going to put in $20,000 of repairs. Where are you going to get that $20,000? You're going to advance it on your line of credit. So now your balance is at $70,000. You can now take this car, and your best friend comes up and says, wow, do I ever like your car? I'd like to buy it for $100,000. So now you have $100,000 coming back to you. Let's see an example of how we could apply that $100,000. First of all, we have a line of credit balance of $70,000. So we want to pay that back, and we're going to have $30,000 left over. So let's pay back the $70,000 to our line of credit. Now we've got $30,000. Let's take that $30,000 profit. Let's make a lump sum payment against our mortgage. Look what happens. The mortgage just reduced. The line of credit just increased. Your HELOC balance is now gone, and your global limit is set at $800,000. So let's do a quick recap. The global lending limit does not change once it's registered on your mortgage. You are allowed to borrow $800,000. You do not need to requalify. Your approval is in place. Let's quickly reset some of these items. The mortgage is based on the appraised value. In this case, it's $1 million. The global limit is set at 80% off the appraised value. You can get your regular house mortgage as a component of your global lending limit. You make regular amortizing payments on that. Whatever you're not using is available to you as a line of credit. When you advance on your line of credit, the remaining balance decreases. The global limit is $800,000. If you make a lump sum against your mortgage or payments over time, that gets applied to the mortgage balance. Let's see what happens with inheritance. Your mortgage keeps getting smaller and smaller. Your line of credit gets bigger and bigger.